Section D, essay type number 6. Let's read the information. EcoClock manufactures 4 environmentally friendly consumer products, and the firm is organized as 4 operating centers, each responsible for a single product. The main mechanism of each product is the same and requires an identical initial processing step, although subsequent processing for each product is very different. EcoClock's management has decided to centralize the initial processing function and purchase new equipment that has a 40,000 units annual practical capacity. For budgeting and costing purposes, the initial processing function will be assigned to a new center E. Currently we have 4 centers, but we are going to set up a new center. Shown below is the budgeted production for the product center. So Center A produces 5,000 units, 7,500, 4,000, 6,000. Fine. A large part of the manager's compensation is derived from bonuses that they receive for meeting or exceeding the cost targets. So the bonuses are given on cost targets. The managers of Center A through D each agree that they should be charged with the variable cost per unit that are delivered by Center E. Center E will be taking care of the first initial step of production process, and then the further processing would be done in department A, B, C, and D. And the initial cost incurred in Center E, managers of these department A through D, they say that they may be charged for the variable cost of production in Center E. However, they disagree about the allocation of fixed cost of Center E, primarily because they believe that the new equipment has a much larger capacity than is necessary, and they do not want to be charged with the cost of the unused capacity. Okay, that's right. They have a valid point. But at the same time, asking them to be charged only for variable costs, again, this is not right. So these are the two extremes. On one hand, you are saying that you should be charged for variable costs only, not fixed cost. But someone will have to bear the fixed cost. Fixed cost is necessary for manufacturing process. Rent, insurance, depreciation, property taxes, plant managers and supervisors' salary. It's an essential component of manufacturing. How can we ignore? This point is valid. Maybe the plant is utilized only up to 30%, but the depreciation will be charged for the whole 100%. So the 70% excessive charge, unused capacity, that's what these managers A through D, the manager of these centers, are a little worried about. Okay. The fixed cost for Center E total $150,000, while the variable cost per unit is $6. So the item that Center E makes, $6 is variable cost and $150,000 is the total fixed cost of Center E. These managers from A to D, they want to be charged only for $6 cost. That's the variable cost in Center E. And this is the cost they're a little worried about. Okay, let's see question number 1. Assume fixed costs are allocated based on the proportion of units produced by each center. What is Center D's cost per unit? Okay, going back to the case study. Now you can see, let's erase this. This is your variable cost, $6, right? This is the fixed cost. And in the first question, it says that the fixed cost, $150,000, is to be allocated based upon the annual production of these 4 centers. If you add these all, 4, 6, 10, 15, 15 plus 7,500, 22,500. So if this is the case, calculate the unit cost. Very simple. This is your variable cost, $6. This $150,000 fixed cost would be based or allocated based upon total 22,500. Right? So 150 divided by 22,500 gives you a total of 6.6666 and so on. So adding this $6 and 6.67 gives you a total unit cost of 12.67 as per the question's requirement. 12.67. Assume fixed costs are allocated based on the proportion of units produced by each center. What is the Center D's per unit cost? Per unit cost for all of them are same. 12.67 for A, 12.67 for B, 12.67 for C and D. If this is the basis used, then the cost is the same for all. because we have used the common division 22,500, right? Assume fixed costs are allocated based on proportion of units fixed cost by each center. So the unit cost would be the same for all. What is the center D's unit cost? 12.67. A same, B same, C same. 12.67. Right? What next? What would be center A's per unit cost if center E's fixed cost, which is $150,000, are allocated based on the practical capacity? $150,000 based upon practical capacity. Let's go back to the scenario. Here we go. This is your practical capacity, $40,000. This $6 variable cost, $150,000 fixed cost of center E to be allocated on 50,000 units gives you the per unit fixed cost. 150,000 upon 40,000 gives you 3.75. So adding 3.75 to the variable cost gives you a total cost of 9.75. It's as simple as that. And then the people say asset type is a very difficult part of the exam. I believe this is the easiest one. This is the easiest one. So it's 9.75. 9.75. Let's go and see the result. Simple, 9.75. You just need to show the working. I don't think so. This text is needed. Just the computation and you're good to go. Right, done. That's all. Next, although allocating center E's fixed cost on per unit produced basis seems equitable, 22,500 is the equitable basis, the manager of center C is worried about center B's reducing the number of units produced. Calculate the center C's per unit cost with no change in production. If there is no change in production, nothing is changed, everything is the same. Everything is the same. If there is no change in production, everything is the same. It's just the same question being asked in a different way, just to increase the number of questions on your exam. If the number of units do not change, 22,500, the fixed cost doesn't change. What is the unit cost? Same. $6, 150,000 divided by 22,500. Same number, 150 divided by 22,500. 6.667. To this add 6 and you get 12.67. Same. That's your question number 3. See? 12.67. What's the new thing? Everything is the same. Per unit cost based on production 22,500 units is still the same. The change would occur when the center B reduces its output, which it hasn't done yet. Let's see in the next question. If center B reduces the number of units produced to 5,000, will center C's cost increase or decrease? He's playing with you guys. Is it calling it an assay type is an insult to the assay type? It's too easy. There's nothing complex, straightforward computations. So if center B reduces its production from 7,500 to 5,000 units, it's anyone's guess the unit cost would increase. Why? Because the denominator has fallen from 20,500. Reduction has been 20. It's now 20,000. The denominator, the allocation base has now fallen. Since the denominator falls, the unit cost goes up. So the unit cost 150,000 fixed cost 150. The allocation base now is 20,000. So 150 divided by 20,000. It's 7.5. Fixed cost per unit 7.5 charged to A, B, C, D. Fixed cost plus variable cost added gives you a total of 13.5. So it will increase, as you can see. It has gone up from 12.67 to 13.5. What was the exact question? 13.5 is the new cost. Let's see. Question 4 said, if center B reduces the number of units produced to 5,000, will center C's cost increase or decrease? Surely increase. And by how much? The original cost calculated previously was 12.67, and now the cost has gone up to $3.5 per unit because B has reduced its production from 7,500 down to 5,000. So that has resulted in more cost, and the difference between these two is 12.67 is 0.83. And that's all. Just in a couple of lines you can explain the idea and get the full credit and move on. Question number 5. The center managers are concerned that being charged for unused capacity, a valid point, will impact their bonus. Unused capacity, since a new machine not fully utilized, unused capacity charged to these production departments will reduce their profitability, hence their bonuses. So they are concerned. Explain how company management could alleviate the concerns. What the company can do. The company can charge only the capacity utilized. Unused central capacity may not be allocated. Unused central capacity could not be allocated to operating centers, but to some centralized expense. So only charged to the departments that they have used. The only used capacity, the unused capacity should be charged as an overhead rather than charging to these 4 centers. So management could then be evaluated by other measures. Let's say, okay, we could have continue allocating cost in a current way. We can evaluate the performance of managers through some other ways, right? So that this issue can be resolved. So there are other ways to evaluate the performance of manager, not just the profitability. As you know, in the balance scorecard, we have many ways to evaluate the performance. Customer satisfaction, innovation, profit of course as well. So there are 4 different dimensions. I think he will test you on this in the next question. Identify 3 additional measures that could be used to evaluate managers' performance. We can assess managers on quality of the production. We can assess their performance through financial measures, like what we have been doing. And we can also assess their performance through innovation. All these are the aspects of balance scorecard. Quality. Through, how do we measure quality? Through customer satisfaction. How happy are customers? So through customer satisfaction, we can assess the quality. Lower warranty expenses. Lower sales returns. Financial, of course, profitability, lower variable costs, increase in sales, more profit. Innovation, new product features, improvement in the processes, improvement in the manufacturing activities, so on and so forth. So you can just give any suitable response in these 3 dimensions, because they need 3 additional measures that could be used to evaluate the managerial performance. So that ends your essay type 6.